Welcome to Mastering Your Money, the show dedicated to empowering you with the knowledge to build a secure and prosperous financial future. Today, we're embarking on a comprehensive journey into the world of investing. In this hour, we'll demystify the stock market, uncover the secrets of dividend investing, and establish a robust framework for long-term wealth building. Whether you're a seasoned investor or just starting out, this episode is packed with actionable insights to help you make informed decisions. Let's get started. Welcome to the engine room of modern capitalism, the stock market. It might seem like a complex world of flashing numbers and arcane jargon, but its purpose is surprisingly straightforward. The stock market can seem intimidating, but at its core, it's a marketplace where shares of public companies are bought and sold. Think of it as a massive, organized auction. When a company needs to raise significant capital for big projects, like building a new factory, funding groundbreaking research, or expanding globally, it can choose to go public. This means it divides its ownership into millions of small pieces, called shares or stocks, and sells them to investors. When you buy a stock, you're not just betting on a ticker symbol, you're buying a tiny piece of that company. You become a part owner. Your goal is for that company to grow and prosper, which in turn increases the value of your shares, or for the company to share its success directly with you by paying you a portion of its profits, known as dividends. To navigate this world confidently, let's break down some fundamental concepts. So, what exactly is a stock? As we said, it represents ownership or equity in a publicly traded company. When a company first issues stock in an initial public offering, or IPO, it's selling those shares on the primary market to raise capital. After that, those shares are traded between investors on the secondary market, which is what we typically refer to as the stock market, places like the New York Stock Exchange or the NASDAQ. Two key terms to know here are shares outstanding and float. Shares outstanding refers to the total number of shares a company has issued, including those held by insiders like executives and large institutions. The float, however, is the number of shares that are actually available for trading on the open market by the general public. A company might have 100 million shares outstanding, but if 40 million are held by the founder and not for sale, the float is only 60 million. This is important because a smaller float can sometimes lead to more price volatility. Now, how do we determine the overall size of a company? That's where market capitalization, or market cap, comes in. Market capitalization refers to the total market value of a company's outstanding shares. It's a simple but powerful calculation. You multiply the current share price by the total number of shares outstanding. This metric is crucial because it helps us categorize companies into different size tiers, each with its own distinct risk and growth profile. We have megacap companies, the titans of industry valued at over $200 billion. Then large caps, typically between 10 and 200 billion. These are usually stable, well-established leaders. Mid-caps, from 2 to 10 billion, often offer a blend of growth and stability. Small caps, under 2 billion, are generally younger companies with higher growth potential, but also higher risk. And finally, microcaps, which are the smallest and most speculative. Understanding a company's market cap gives you immediate context for its position in the market. But how do we gauge the health of the entire market? Not just one company? For that, we turn to stock market indices. Stock market indices like the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite are powerful benchmarks. They act like a curated playlist, representing the collective performance of a specific basket of stocks. They give us a quick, digestible snapshot of the market's overall health and direction. For example, the S&P 500 tracks 500 of the largest U.S. publicly traded companies, covering about 80% of the entire U.S. stock market's value. It's market cap weighted, meaning larger companies like Apple or Microsoft have a much bigger impact on the index's movement than smaller ones. This contrasts with an equal weighted index, where every company has the same influence, regardless of its size. Understanding this weighting is key to interpreting an index's performance, so we know what a stock is and how the market is measured. But how do we decide which specific stock to buy? How do we evaluate a company? Investors typically use two main schools of thought: fundamental analysis and technical analysis. Think of it like this. Fundamental analysis is like being a detective, investigating the business itself. Technical analysis is like being a psychologist, studying the behavior of the market. Fundamental analysis is the art and science of determining a company's intrinsic value. This means trying to figure out what the business is truly worth, independent of its fluctuating stock price. To do this, we examine everything that can affect the company's future profitability. This includes its financial statements, the balance sheet, income statement, and cash flow statement. We also look at the quality of its management team, its competitive advantages, its position within its industry, and broader economic conditions. We're asking, is this a healthy, growing, and well-run business? To answer that, we use a toolkit of financial metrics. Let's start with the most famous, the price-to-earnings, or PE ratio. It compares the company's stock price to its annual earnings per share. A lower PE might suggest a stock is undervalued, but context is everything. You must compare it to the company's own history and its industry peers. A related metric is the PEG ratio, which divides the PE by the earnings growth rate. A PEG ratio around 1 can indicate a fairly valued stock, while below 1 might signal it's a bargain. Next is earnings per share, or EPS, which is the company's total profit divided by its number of shares. We want to see steady, consistent EPS growth. Revenue growth is also critical. Are sales expanding? We look for durable, consistent growth, not just one-off spikes. We also analyze margins, like gross, operating, and net margins, to see how efficiently the company converts revenue into actual profit. Finally, we look at its financial health with metrics like return on equity, ROE, which measures profitability relative to shareholder equity, and the debt-to-equity ratio, which tells us how much debt the company uses to finance its assets. A lower debt ratio is generally safer. None of these metrics exist in a vacuum, but together they paint a detailed picture of a company's quality and value. Now for the other side of the coin. Technical analysis, on the other hand, isn't concerned with a company's intrinsic value. Instead, it focuses on studying past market data, primarily price and volume, to identify patterns and predict future price movements. The core belief of a technical analyst is that all known information, all the fundamental data, news, and sentiment, is already reflected in the stock's price chart. Their job is to read that chart. They use a variety of tools to do this. Common tools in technical analysis include, first, identifying trends. Is the stock in an uptrend, making higher highs and higher lows, or a downtrend? Technicians also look for levels of support and resistance. Support is a price level where a stock tends to stop falling, and resistance is a level where it tends to stop rising. They also use indicators like moving averages, which smooth out price data to show the underlying trend. For example, when a short-term average like the 50-day crosses above a long-term average like the 200-day, it's often seen as a bullish signal. Other tools like the Relative Strength Index, or RSI, help gauge whether a stock is overbought or oversold. The key is to use these tools to understand market sentiment and psychology, but it's crucial to be aware of the risk of overfitting, finding patterns in random noise that aren't actually predictive. So, which approach is better? The truth is, they aren't mutually exclusive. They ask different questions and can be incredibly powerful when used together. While fundamental analysis helps us identify to buy a high-quality business at a fair price, technical analysis can often help us identify to buy or sell, providing better entry and exit points. Many of the world's most successful investors build a watch list of great companies using fundamentals, and then use basic technicals to patiently wait for an opportune moment to invest. By combining the what with the when, you create a robust and disciplined investment strategy. Imagine your investments not only growing in value but also paying you a regular, predictable income. That's the core idea behind dividend investing. It's a strategy that can turn your portfolio into a cash-generating machine, where steady payouts create a powerful compounding effect over time. Now let's talk about this powerful strategy for income and wealth accumulation. A dividend is a payment made by a corporation to its shareholders, usually as a distribution of its profits. It's essentially a thank you note from the company for your investment and your share of the ownership. While most dividends are paid in cash on a quarterly basis, companies can also issue special, one-time dividends after a particularly profitable period, or even return value to shareholders indirectly through share buybacks, which reduce the number of shares outstanding and can increase the value of the remaining ones. To receive a dividend, you need to understand 3 key dates. The ex-dividend date is the cutoff. You must own the stock this date to be eligible for the upcoming payment. The record date is when the company checks its records to see who the official shareholders are. Finally, the payment date is when the cash is actually deposited into your brokerage account. Companies that pay dividends are typically well-established, profitable businesses with stable cash flows. They often operate in mature industries where they've moved beyond their hypergrowth phase and generate more cash than they need to reinvest back into the business. Think of sectors like utilities, which have predictable revenues, consumer staples, which sell essential products people buy regardless of the economy, or even some technology giants that have become dominant forces in their markets. This financial maturity is a signal of strength and discipline. Instead of chasing every new growth opportunity, these companies choose to reward their owners, the shareholders, directly. So, why is dividend investing so appealing to millions of investors? First, it provides a reliable stream of passive income. This cash can be used to cover living expenses, especially in retirement, or it can be reinvested to buy more shares. This leads to the second and perhaps most powerful benefit, the magic of compounding through dividend reinvestment plans, or DRIPs. With a DRIP, your dividends automatically purchase more shares of the company, which then generate their own dividends. It's a virtuous cycle that can dramatically accelerate your wealth over 10, 15, or 20 years. Third, dividend-paying stocks often exhibit lower volatility. The regular dividend payment provides a cushion during market downturns, as you're still receiving a return even if the stock price temporarily falls. Finally, companies that consistently increase their dividends can help your income outpace inflation, protecting your purchasing power over the long term. But not all dividend stocks are created equal. It's crucial to look beyond a high yield to assess the quality and sustainability of the dividend. To identify strong dividend-paying stocks, we look at several key metrics. First is the dividend yield, which tells you the annual dividend payment relative to the stock's price. Second, the payout ratio, which shows what percentage of a company's earnings is being paid out as dividends. A ratio that's too high can be a red flag. Third, we look for a consistent history of dividend growth. A company that regularly increases its dividend is demonstrating confidence in its future earnings. This leads us to the elite dividend aristocrats, S&P 500 companies that have increased their dividends for at least 25 consecutive years, and dividend kings, which have done so for 50 years or more. For example, if a stock pays an annual dividend of $2 per share and its current price is $50, its dividend yield is 4% to $50. If that same company has earnings per share of $4, its payout ratio is 50%, $2.4. A payout ratio in the 40-60% range is often considered a healthy sweet spot, as it shows the dividend is well covered by earnings while still leaving enough cash for the company to reinvest in its own growth. Remember, while dividends are great, you still need to conduct thorough fundamental analysis on the underlying business. A very high yield can be a yield trap, signaling that the market believes the dividend is at risk of being cut. A company can and will cut or suspend its dividend if its financial health deteriorates. So never invest in a company solely for its dividend yield. Always ensure the business itself is strong, stable, and has a bright future. Building long-term wealth isn't about getting rich quick. It's about consistent, disciplined effort and smart strategies. This is where we shift our mindset from analyzing individual stocks to architecting a financial future. It requires patience, a steady hand, and an understanding of the powerful forces that can turn modest savings into significant nest eggs over time. Forget the daily market noise and the chase for the next hot stock. Here, we focus on the timeless principles that have built fortunes for generations. Let's explore the foundational pillars of a successful long-term investment plan. First and foremost is a concept so powerful, it's often called a miracle of finance. The power of compounding. We briefly mentioned this with dividends, but its importance cannot be overstated for all investing. Compounding is the process of earning returns not just on your initial investment, your principal, but also on the accumulated returns from previous periods. It's a snowball effect for your money. Einstein reportedly called it the eighth wonder of the world, adding, "He who understands it earns it, he who doesn't pays it." The single most critical ingredient for compounding is time. The earlier you start, the more time your money has to work for you, allowing the growth to become truly exponential. Consider this. If you invest $500 a month starting at age 25, assuming a hypothetical 8% average annual return, you could have over $1.7 million by age 65. But if you wait just 10 years and start at age 35, that same monthly contribution would result in around $750,000. That 10-year delay costs you nearly $1 million. That's the staggering power of compounding. Even small regular contributions can grow into substantial sums over decades. Time is, without a doubt, your greatest ally in investing. A great mental shortcut to understand this is the Rule of 72. It's a simple way to estimate how long it will take for an investment to double in value. Just divide 72 by the annual rate of return. For example, an investment with an 8% annual return would take approximately 9 years to double, because 72 divided by 8 is 9. If you could achieve a 10% return, it would double in just over 7 years. This rule vividly illustrates how even small differences in your rate of return can have a massive impact over the long haul, thanks to the magic of compounding. Our next pillar is what Nobel laureate Harry Markowitz called the only free lunch in investing. Diversification. This is the golden rule. Don't put all your eggs in one basket. In investing terms, diversification means spreading your investments across various assets, industries, and geographies to reduce risk. The idea is that by holding a variety of assets that react differently to the same economic event, you can protect your portfolio from a major loss if one part of it performs poorly. True diversification goes beyond just owning a few different stocks. It involves spreading your capital across several layers. First, across asset classes like stocks, bonds, real estate, and commodities. Historically, when stocks go down, high-quality bonds often go up, providing a cushion. Second, across geographies. Investing in different countries and regions, like North America, Europe, and emerging markets, protects you from a downturn in any single country's economy. Third, across sectors and industries. A portfolio heavy in technology might suffer if that sector hits a rough patch, but holdings in defensive sectors like consumer staples or healthcare could help stabilize it. And fourth, across company size, or market capitalization. Spreading investments among large established companies, mid-sized growth companies, and smaller, more volatile companies provides a blend of stability and growth potential. The goal isn't to eliminate risk entirely. That's impossible. The goal is to manage it. If one part of your portfolio performs poorly, other parts can offset those losses, leading to smoother, more predictable returns over time. This leads us directly to our third pillar, which puts diversification into practice: asset allocation. This is closely related to diversification and involves the crucial decision of how to divide your investment portfolio among different asset classes. This decision should be tailored specifically to you, based on your personal risk tolerance, your investment time horizon, and your specific financial goals. Are you saving for a house in 5 years or for retirement in 30? Your answers will dramatically change your ideal asset mix. A common rule of thumb is that as you get older, you might shift from higher risk, higher reward assets like stocks to lower risk, more stable assets like bonds. This is often called a glide path. A younger investor with a long time horizon can afford to take on more risk for potentially higher returns, so they might have an 80% or 90% allocation to stocks. Someone nearing retirement, whose priority is preserving capital, might have a much higher allocation to bonds, perhaps 50% or more. It's also crucial to periodically rebalance your portfolio. Let's say your target is 70% stocks and 30% bonds. If stocks have a great year, your portfolio might drift to 80% stocks. Rebalancing means selling some stocks and buying bonds to return to your 70-30 target. You can do this on a set schedule, like once a year, that's calendar rebalancing, or whenever an asset class drifts by a certain percentage, like 5%, that's threshold rebalancing. This disciplined process forces you to sell high and buy low, maintaining your desired risk level. Our fourth pillar is a strategy that automates discipline and removes emotion from the equation. Dollar cost averaging, or DCA. This is a simple yet powerful strategy where you invest a fixed amount of money at regular intervals, say $200 every month, regardless of the stock price. When prices are high, your fixed investment buys fewer shares. When prices are low, it buys more shares. Over the long run, this strategy helps to average out your purchase price, reducing the risk of investing a large sum of money right at a market peak. Now, is DCA always better than investing a lump sum? Not necessarily. Statistically, since the market tends to go up over time, investing a lump sum as soon as you have it has often led to better returns. However, that approach carries the risk of bad timing and can be emotionally difficult. DCA smooths out the volatility and makes investing a consistent habit. It takes the guesswork and emotion out of the decision, is now a good time to buy, and encourages disciplined, consistent contributions, which is the bedrock of long-term success. Finally, let's talk about the psychological side of investing. It's vital to understand and manage risk and volatility. The stock market is inherently volatile. Prices go up and prices go down. Short-term fluctuations, even sharp ones, are a normal and expected part of the process. These drops are called drawdowns. It's not a matter of the market will have a drawdown, but long-term investors succeed by focusing on the overall upward trend and not panicking during market downturns. Your biggest enemy is often not the market, but your own emotional reactions to it. Seeing your portfolio value drop by 20% or 30% is scary, but selling at the bottom locks in your losses and prevents you from participating in the eventual recovery. In fact, for those with a long-time horizon, downturns can present incredible opportunities to buy quality assets at a discount, thanks to strategies like dollar cost averaging. Ultimately, your risk tolerance is personal and unique to you. It's a combination of your financial ability to withstand losses and your emotional willingness to do so. This is why it's critical to only invest money you can afford to keep invested for the long term. Never ever jeopardize your emergency fund or money you need for essential living expenses for the sake of investment returns. A solid financial foundation, including that emergency fund, is what gives you the staying power to ride out market volatility without being forced to sell at the worst possible time. Mastering your own behavior is just as important as mastering these strategies. Let's turn knowledge into action. In the next few minutes, we'll translate principles into simple steps you can follow today. Clear goals, the right accounts, smart investing habits, and a plan to avoid common mistakes. Start with intent, then build systems that keep your money working even when you're busy. Here's how to put your plan in motion. Step 1. Set clear financial goals. What you want, when you want it, and how much it costs. Your purpose defines your time horizon and the risk you can take. Be specific. Retire at 65 with 1.2 million. Buy a home in 5 years. Or fund a child's college. Assign each goal a date and a dollar amount. Then map your contributions to that target. Step 2. Build an emergency fund. Aim for 3 to 6 months of essential expenses. Keep it liquid in a high-yield savings account or money market, so it's ready for job loss, medical bills, or repairs. This buffer prevents you from selling investments at the worst time. Step 3. Choose your platform and account type. Use a reputable, low-fee broker with easy automation. Start with tax-advantaged accounts if available, a 401k through work, then an IRA, traditional or Roth. Roth IRAs use after-tax dollars and can offer tax-free growth. If you qualify, a health savings account, or HSA, can be triple tax-advantaged when paired with eligible health plans. After filling these, use a taxable brokerage account for extra investing flexibility. Prioritize low costs, expense ratios and trading fees add up, and turn on security features like two-factor authentication. Step 4. Decide your core investments. Favor broad market index funds or ETFs for instant diversification at low cost. Pair stocks and bonds based on horizon and risk tolerance. Common mixes include 80-20, 70-30, or 60-40. Keep it simple and stick to your target. Step 5. Automate contributions with dollar cost averaging. Set a fixed amount each month. Automation reduces stress and avoids bad timing. Step 6. Create a rebalancing plan. Markets move, your allocation drifts. Rebalance on a calendar, say once a year, or by thresholds, like when an asset class is 5% off target. That discipline nudges you to sell high, buy low, and keep risk where you want it. Step 7. Manage risk and behavior. Write your plan, automate contributions, and review annually. Ignore day-to-day noise and focus on your timeline. Now, common pitfalls to avoid: trying to time the market, chasing hot tips or high yields, overtrading, paying high fees, ignoring taxes and account types, skipping the emergency fund, concentration risk in one stock, sector, or country, using leverage without understanding downside, making emotional decisions after headlines, and neglecting inflation's long-term impact. Keep costs low, diversify broadly, and let time and consistency do the heavy lifting. Start small, automate what you can, and schedule a brief yearly review. Simple, repeatable steps, compounded over time, build real wealth. We've covered a tremendous amount of ground today, from the basics of stock market analysis and the power of dividend investing to essential long-term wealth-building strategies. Remember these key takeaways. Understand the business. Use fundamental analysis to evaluate a company's health. Leverage dividends. Reinvest them for powerful compounding. Embrace compounding. Time is your greatest asset. Start early. Diversify wisely. Spread your risk across assets, industries, and geographies. Be patient and consistent. Investing is a long-term game. I encourage you to take these insights and apply them. Start small, stay disciplined, and commit to your financial future. The journey to financial independence is truly within your reach. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more valuable content, and hit the notification bell so you don't miss our next episode. I'd love to hear your thoughts and any questions you have in the comments below. Thank you for joining me on Mastering Your Money. Until next time, invest wisely and build the future you deserve.